Hello, very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. Very good morning. Today will be the 3rd of July 2025, Thursday. So before we kickstart today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the gist of today's Daily Dose of Market Insights, which is the intraday technical outlook on those broad-based cross-asset classes that we cover on a daily basis, let's have a quick recap of what has happened yesterday in terms of news flow, economic data release, and as well as key economic data release that took shape earlier this morning, Asia session, before the start of our Daily Dose at 11 a.m. Singapore time, and their impact on the respective broad-based cross-asset classes. So let's start with yesterday's movement on the broad-based cross-asset classes first, more accompanying to the major US stock indices. So from the major US stock indices, we continue to see a rotation play. So prior to yesterday, which was on Tuesday, the US session, the rotation play was outperformance of the Dow Jones Industrial Average versus the mega cap big tech stocks. But yesterday was seeing this rotation play back into the mega cap technology stocks for the Wednesday US session, where the top performer among the four major indices, I would say not really the top performer, the second top performer will be the Nasdaq 100, up by 0.73%. The Russell 2000 small cap is a top performer, up by 1.31%, whereas the more conservative value oriented stocks or component stocks, which comprises which are inside the Dow Jones Industrial Average, yesterday almost I would say ended almost at the unchanged mark at negative 0.02%. So I could see over here is that the S&P 500 has a very strong start throughout the US session since the start, and it continued to trade higher as the US session progressed, and it closed near the high and also a fresh all-time high as well as 6,227. Very similarly for the Nasdaq 100, it managed to actually went all the way up as well, but didn't close a brand new fresh all-time intraday high, as this high was pretty much similar to the high that was made on a Monday at the start of this week at 22,641. Whereas the Dow Jones Industrial Average kind of traded sideways yesterday, open up pretty strongly, but then thereafter there's some profit taking shape over here. So it's more of a rotation play yesterday rather than a intraday weakness on the major US stock indices. So I'll say that yesterday movement is pretty much healthy for the bulls. And also one of the factor that is driven this mega cap outperformance. Okay, over here, let me share with you the chart of the S&P 500 heat map. So we can see over here the S&P 500 heat map, the mega cap technology stocks actually came raw back in life. So after that dramatic sell-off that was seen on Nvidia the prior session, that means i.e. on Tuesday, those gains has been this gains has swept up. This gains has actually recovered Tuesday losses. All right, and also Apple is up by positive 2.22% as well. So that one that is still lagging behind was Microsoft and Meta, but as well as Amazon, but they didn't actually fall that much. All of them fall less than 1%. All right, over here. So one of the reason also this ongoing because one of the I would say not indirect factor that is driving this solid performance on the major US stock indices, primarily on the mega cap technology stocks, is due to some trade deal optimism that is between US and Vietnam over here. Let me share with you guys All right. So US managed to reach a deal with Vietnam, even though there's no official announcement that's being made, but that came out from Trump himself via his social media post. So Trump via social media post said that he has already reached a trade deal with Vietnam following weeks of intense diplomacy. So what you see that over here right now, there is actually two deal of this trade deal that is being agreed between, so-called agreed between US and Vietnam based on Trump's pre-announcement, okay, before the respective official announcement that is being made from from the Commerce Secretary, or even from the various respective we call it relevant departments of the US, the state departments of the US. So what Trump mentioned over here is that he said that that includes 20% tariffs on Vietnam exports over here. So that means, i.e., initially there was actually a very high tariff, about 40 over percent. So that has been reduced to 20% tariffs, and also a 40% levy on goods deemed to be transshipped through the country. That means this is what I call a third party. That means, i.e., if China originated goods coming from China flow into Vietnam, then Vietnam re-export it out to US, that will be at a 40% levy over here. So this particular 40% levy that's been slapped on Vietnam, or that means, i.e., deemed as transshipped through the country, potentially there could be a risk of Chinese retaliation back into US, because Chinese authorities last 2 weeks say that whatever trade deal that is US has with other of its trading partners cannot be detrimental to Chinese products. So this 40% levy on goods deemed to be transshipped through Vietnam is potentially a detrimental levy that could impact Chinese products heading into Vietnam. All right, so based on this Bloomberg economic study saying that this US Vietnam deal risks Chinese reprisal. All right, so this new US Vietnam trade deal, yeah, on the surface, it may look very, very good. That causes the US stock market to be very bullish. But however, includes a 40% tariff on goods deemed to be transit through Vietnam. That may provoke retaliatory steps from China. That means retaliation from China itself. So potentially this agreement may also lead to Vietnam losing 25% of its UX export in the medium term, putting 2% of its annual economic output at risk, and could have broader implication on for other countries. So in the short term, yeah, we may see a bit of bullish sentiment back into the US stock market, but on the longer term basis, there could be this risk of a economic adverse impact back into the US economy. But markets tends to be very short term in nature. So, and do not forget, over here is that market also dying in need of liquidity that is much needed to pump up the US stock market further. So this liquidity will come from the US Federal Reserve monetary policy. At the moment in time, the US Fed is still pretty much stubborn, refusing to cut rates uh, and keep on kicking down the interest rate, cut down the calendar. So later I'll touch you more about the CME Fed Watch 2 after yesterday's economic data and all these events that take shape. Right now, market is now expecting a much more dovish Fed going into the Q3 and Q4 of this year. So that could be also a potential factor that the markets, the US stock market, could continue to rally despite all this negative adverse impact coming out from this whole array of complicated trade tariffs policy that the US White House wants to implement that have a longer term detrimental impact of the US economy. So at the moment in time, stock market is always like to be supported by extra liquidity. So if this extra liquidity come up from the US Federal Reserve, that could deem as a positive factor to maintain that medium term bullish trend in the US stock market. Right, so because of this negative impact coming out from a retaliatory steps out from China, that actually causes a negative feedback loop on the very short term to the Hang Seng index over here. So if you look at the Hang Seng index, is actually trading down by almost 1% again, wiping out yesterday's intraday gain. All right, so yesterday Hang Seng rallied, but come broke above our short-term resistance level that I mentioned around the 24,000 level, and it actually sold off in today's Asia session. due to the fact of this negative news flow coming out from Trump, indirectly so-called putting a warning sign to China, stating that asking them not to use Vietnam as a conduit to actually ship their goods to US by not having to pay any tariffs. So that is a negative news flow for the Hang Seng Index. And also on top of that, other than this negative news flow that causes the Hang Seng Index to plummet, one more negative economic data is more pertaining to the state of the Chinese economy. That's considered as a tier 1 data, which is the privately compiled Caixin PMI services PMI data that is out in today's Asia session at 9:45 a.m. So this Caixin services PMI data actually slipped down more than expected to an 8-month lower. So it's still expansion at 50.6, but the rate of expansion slowed down dramatically, way below market is expecting. So don't forget the Caixin services PMI, which is different from the nationally compiled PMI. We call it the MBS non-manufacturing PMI, which was out earlier on Monday. So let me share with you the earlier data. Correct. So that was out earlier on Monday. So this NBS non-manufacturing PMI, deemed as also NBS services PMI. So this is being compiled by the one of the statistical board in China. So that's deemed as an official China data compiled by the official stat board. Okay, so the reason about this MBS non-manufacturing PMI, the data came in better than expected, right? Market is expecting 50.3, it came in by 50.4. So what is the stark difference between the MBS non-manufacturing PMI for China and the Caixin services PMI data for China is the MBS non-manufacturing PMI exclude SME. They only consist of those large state-owned enterprise, whilst the Caixin services PMI is more comprehensive. It consists of those smaller, privately so-called owned SME. Right, so market participant tends to look at the Caixin services PMI as a much more comprehensive state of the economic health of the Chinese economy, because it consists of both the state-owned large enterprise and those privately owned SME. So after taking into account of the privately owned SME survey, the services sector in the Chinese economy is not so rosy as earlier expected, because markets expecting 51, just a slight dip from below 51.1 that was previously recorded in May, and the actual figure for June came in at an 8-month low. So you look at the trend. So the rate of growth actually slowed down pretty significantly, given the fact that anything that's above 50 is showing signs of expansion. So you look at the 3-year trend. All right, so it's the weakest reading in the services sector since September 2024. So that's about 8-month lower over here. So what you could see is that the trend continues to print a series of lower high. So that actually also spoke market, we call it in the short term as well, stating that the Chinese economy services activity is not picking up steam, and given the fact that we know that export growth may be trimmed off due to the ongoing array of Trump tariffs that indirectly target China using the rest of the country as well, the rest of the world as well. And given the fact that export is one of the engine that is driving that so-called 5% growth target, mainly in the last 3 to 4 years for the Chinese economy, and given if the services sector can't pick up the slack, there could be a big risk that very pretty much the Chinese policymaker may find a hard time reaching that 5% growth target growth this year, because the export engine got trimmed off due to Trump's tariffs against China, and also using the rest of the world to target China. And the services sector in China is not picking up steam, so eventually that create a negative feedback loop into the Hang Seng Index. All right, so later I'll share with you what is the intraday technical outlook for the Hang Seng Index in terms of the key levels to watch, and that's pretty much for the state of the US stock market, and as well as the Asia Pacific stock market for today. And before we jump into the FX market, also Trump continues to threat Japan, stating that he sticks with the 9th of July tariff deadline. All right, so previously there's some speculation that Trump may actually back down and extend the 9th of July tariff deadline for for Japanese officials, pardon me, and US officials to negotiate whatever things that they deem still in what I call it not yet to be what I call lingering rate hearings that yet to be resolved, because primarily Japan side of the story is that they refuses to allow US rice products to head into Japan, and Trump because of this pretty much unhappy, and he actually wanted to slap higher tariffs of 30% to 35% if Japanese officials refuse to adhere to US requests over here. So primarily it's more pertaining to the rice exports are heading to Japan. Right. So with that, market doesn't seems to be so-called uh, pretty much in pretty much pricing in this higher Trump tariffs on Japan, because based on Trump past behavior, he tends to back off at the last minute and give a bit of leeway, because by putting a very high tariffs on Japanese products heading into US, especially Japanese automobiles, where US consumer tends to also uh, pretty much needed as well, that could actually boomerang back into the US economy. So that's why a market participant don't deem this Trump trade as quite serious, because they still believe that he may back down. So the Nikkei 225 is not experiencing a huge steep sell-off today. So in fact, they're actually now at the unchanged mark at negative 0.07%, despite Trump trade to keep on using his hardball tactics to force the Japanese side of the officials to actually adhere to US requests before the 9th of July deadline expires. All right, so that's for the Asia market over here. So with that, let us now look at the FX market. So the FX market yesterday, one of the outlier will be the sterling dollar. All right, so this sterling dollar also surprised me as well, because it's more political driven internally. We see an outlier of dollar strength against the sterling. So the sterling was the weakest against the dollar among the major pair, whereas the major pair continues to trade strongly against the dollar. So the dollar continues to remain weak against the Swiss franc, which it performed the worst, down by negative 1.21% based on a 5-day rolling performance basis as we are speaking right now, followed by the euro dollar, where the dollar is down against the euro by negative 0.9% and also down against the Japanese yen by negative 0.7%. So if you look at the 1-day rolling performance, all right, over here, we start to see dollar strength coming in the dollar against the sterling, which is up by 0.12%, then followed by against the Aussie, up by 0.18%. Then because the Aussie has a close relationship with the Kiwi, so the dollar is so up against the Kiwi by 0.23% on the 1-day rolling performance basis. So the reason to explain why Aussie is so weak against the dollar is also pertaining due to the health of the Chinese services sector, where the Chinese services PMI came in below than expected, all right, by showing a, and we know that the Chinese, the Australia, we call it, has a pretty much significant trading activity with China. That means, i.e., the China tends to actually import various raw resources products to Australia. So given if the services sector in the Chinese economy is not doing well, there will be less tendency for Chinese consumer or businesses to consume more Australia raw materials. So that actually explains why the Aussie weakened in today's Asia session. And those who recall in my yesterday's daily dose, I do stress that there is a short-term bearish technical element on the Aussie dollar below a key short-term pivotal resistance at 0.66, and there could be ongoing minor corrective decline within this just started medium term uptrend phase after that last week bullish breakout from a 7-month range of 7 week of range consolidation in the Aussie dollar. So later I'll touch on more about that when I cover the short term intraday technical outlook on the Aussie dollar. So now back to the reason why the sterling dollar is the weakest against the dollar yesterday is due to internal political reason of the UK political cycle. Is that right now, okay, over here, okay, so the UK market slides actually because of yesterday there was actually a debate in the UK Parliament where the opposition party actually opened up a question to the current incumbent, which is the Labour Party, and the Labour Party PM Reeves over here didn't actually give a very firm reply back to the opposition party in UK that he will back his chancellor. So Chancellor Reeves is considered as the Treasury Secretary in terms of UK, or put it as the Finance Minister over here. So the Finance Minister of UK didn't get the full backing of its Prime Minister, the UK Prime Minister, and given the fact that Rachel Reeves, which is the finance minister of UK, is more of a fiscal hawk. That means her duty is to balance the books in the UK government. That means preventing from the UK budget deficit to widen further. And because there's some ongoing displeasure because due to Rachel Reeves' fiscal hawk stance, that means she refusing to actually advocate aggressive expansionary fiscal policy that led to the risk of her removal. And because publicly in the debate that's being aired live on in the UK parliamentary session yesterday, UK Prime Minister didn't actually directly back Rachel Reeves when the opposition party questioned her whether will she be still around in the next general election in UK that's maximum going to be held in 2029. And because of this lack of confidence coming up from the UK Prime Minister, that Chancellor Reeves may be replaced by someone who is much more in favor of aggressive fiscal expansionary policy, and that could widen the UK fiscal deficit much further. Indirectly that could lead to a detrimental impact on the sterling pound. So that's why it causes the sterling pound to slump more than 1% below 1.36 yesterday, and that actually explained the reason why. So later I'll share with you from a technical perspective, the micro uptrend has already been damaged on the intraday basis, and potentially we may see a mean reversion decline on the sterling dollar from a multi-day perspective. But however, the major and medium term trend is still intact, or uptrend still intact on the sterling dollar. Okay, later I'll touch on more when I cover the second segment of today's daily dose. All right, so that's pretty much sum up the situation over here. And what we could see over here is that, let me touch on the gold price. Okay, let me touch on the gold price. Okay, so for gold, it continues to hold in a range, in a very short term range yesterday. Okay, let me expand up the gold chart. All right, over here. So what I could see, the gold price, okay, it continues to trade. Come on. Okay, we in the 20-day moving average, which is at 3,360, come break above it yesterday, and also managed to hold support at the 50-day moving average as well. So yesterday it managed to have the third consecutive session of gain since the test of this medium-term ascending channel support at around the 3,240 level that has been in place since 31st of December 2024 low. All right, so 3 days of price action positive, but still can't break above the 20-day moving average, where it has a bearish breakdown on last Tuesday. All right, so still be trapped being really a very short-term range configuration. Two things I could explain why is it being dealt in this such a way. Number one, support at the 50-day moving average is being caused by a weaker US dollar in general, because despite that sterling dollar weakness on the US dollar, the other major currencies still remain strong against the dollar. All right, later I'll share you by looking at the dollar index. All right, or the dollar index still remains on the weaker side. So that actually support go on the bottom, on the downside over here. At the upside, at this point in time, market is still waiting for key economic data to come out of US, which is pretty much due today, because Friday is a US holiday. So the non-farm payroll data, instead of releasing on Friday, it will release today instead. together with another tier 1 US economic data that is heavily focused on a sector that has 3/4 of contribution to US annual growth from the last 10 over years, which is the ISM services PMI data. So that also potentially causes traders to actually do not want to take aggressive position, to actually have a bearish bias against gold at this point in time, despite the fact that we start to see a dollar weakness being pronounced in the last few session over here. So how do I see dollar still remains weak? By looking at the dollar index, which continues to trade below the 20-day and the 50-day moving average. So this is the daily chart of the US dollar. All right, ever since it broken down below the 97 40 97.50 long term 97.40 long term circular ascending channel that was previously in place since May 2011. All right, so very clearly there's a monthly bearish breakdown and a weekly bearish breakdown below it last week over here. So this is a pretty uh, not so rosy sign for the dollar from a multi-week to multi-month perspective, all right, because it's broken below a long-term circular ascending channel support. Previously was in place since May 2011 low, so that indicating the start of a major downtrend phase for the US dollar. All right, so let's sum up the first segment of today's daily dose. So let us now move on to the second segment. Okay, before I touch on the second segment of the daily dose, let me share with you, before I forget, it's very important, because prior to today's key release of the US tier 1 data, that is the NFP non-farm data and the ISM services PMI data, let's see what is the pricing like in the CME FedWatch tool that the CME used to calculate the market expectation on whether the Fed will cut, hike, or hold on the various FOMC dates, right, based on the trading behavior of traders in the Fed funds futures market. So by looking at the next meeting on 30th of July, the Fed funds futures market traders are still assigning a high probability of 75%. It reduced slightly from last week, about 80% plus to 75%, because you know that certain US data is getting weaker and weaker by the day, especially the labor market data, and also the ISM manufacturing data as well that was released on Monday, still showing signs of contraction. So, but markets still believe that Fed Chair Powell, that they will still wait and hold in the July meeting, but assigning a high probability of 75%. So it was down slightly a day ago at 79%. All right, so still high at 75%, that the Fed will maintain its Fed funds rate at 4.25% to 4.5%. All right, but however, if you look down the aggregated, that means down the calendar month ahead, very high chance of 91% that the Fed will ignite its first 2025 rate cut to be on the 17th of September FOMC meeting, and also a very high chance of 90% that the next cut will come in at 29th of October. And now we have another high chance of more than 50%. About a day ago, it was around at 51, 52%, and this has brought up to above 60%. Now at a 66% chance that the Fed will do a third cut on the last meeting in 2025, which is the 10th of December FOMC meeting before 2025 ends, to bring the Fed funds rate down to 3.5% to 3.75%. So now there's a higher chance that there could be a potentially third cut coming in December. So that is actually one more additional interest rate cut that is much more dovish than what the US Federal Reserve officials on their median forecast in their latest dot plot last month, where they only pencil in two potential 25 basis point cut for 2025. All right, so that also explain potentially it could support the ongoing medium term to major trend dollar weakness going forward. All right, so that's pretty much sum up the first segment of today's daily dose. So very quickly, let me go to the second segment. So let me expand my screen. So the second segment, firstly, let us cover the short-term intraday technical outlook on the major FX dollar pair, starting with the euro dollar. So the euro dollar yesterday managed to survive at our short-term pivotal support level at 117.45 during the onslaught of the sterling sell-off that took shape at around the 3 p.m. mark Singapore time. So with that, we still got to respect the ongoing bullish bias of the euro dollar, given the fact that it managed to survive the 117.45. So without doubt, this 117.45 is a key inflection level to manage to maintain the bullish sentiment. So for today, we were still using 117.45 as my short-term pivotal support level, maintain our intraday bullish bias. First resistance it got to clear fast will be at 118.25. Above 118.25 exposes 118.70 next, and followed by 119.10, which is a 0.7618 Fibo extension taken from the low of 23rd of June. However, if price action did a bearish U-turn with a bearish breakdown and hourly close below 117.45, then the bullish bias view will be invalidated to kickstart a minor corrective decline back towards the 20-day moving average. That means it's a mean reversion decline scenario. Next intermediate support level to watch will be 116.85. Below it exposes 116.30, maximum 115.80, which is corresponding with the rising 20-day moving average as well. Next up will be the sterling dollar. So the sterling dollar yesterday broke down below our Titan short-term pivotal support level at 136.70. Right, so let's take a look at the bigger picture. Yes, yesterday we see a steep sell-off. So we look at the bigger picture, which is the daily time frame chart. So overall, this daily time frame chart over here, starting from the low of 13th of January, is still trading within a medium-term uptrend phase. And from a bigger picture, the entire rally is still within a major ascending channel from 26 September 2022 low. So this one, if you go to the weekly chart, we can pretty much see it pretty clearly over here. All right, so this is the major ascending channel kicking start from the low of 26th of September 2022 after that dramatic multi-month sell-off. So right now we are still in a major uptrend phase, and from the low of January 2025, we kickstart a medium-term uptrend phase within its major uptrend phase. So far, it refuses to break above this resistance at 137.50. That is the 13th and 14th of January 2022 swing high area. Tested one time, two times, three times, four times, and five times in the last 5 sessions. But overall, if you look at the trend of the daily RSI, they are not showing any signs of exhaustion because it hasn't hit the overbought level yet. There's no bearish divergence as well. All right, so if you look at the daily RSI, is having a higher high over here. No bearish divergence. So what you could see potentially in the shorter term, we could start to see a kind of a multi-day corrective pullback or a multi-day mean reversion decline within this medium-term uptrend phase that is still intact to go back towards the 50-day moving average that has been providing a good solid support since the retest of it on 7th of April. All right, so on the shorter term, yes, I would turn bearish, but when it comes close to the 50-day moving average, I'll be looking out for bullish elements to reinsert back my bullish bias view, given the fact that the longer term picture on the sterling dollar still remains skewed towards the bulls rather than skewed towards the bears, as explained in those key elements that I highlighted to you guys a couple of seconds ago. So right now, let us switch back our focus now to our intraday technical outlook for the sterling dollar. So on the intraday technical outlook sterling dollar, for sure, we got to use a lower time frame chart, which is the hourly chart. So this point of rejection over here during the Asia session where it attempt to actually bounce, but it can't bounce much further and it reject off it. And where it reject from yesterday's pivotal support, now turns into a key pullback resistance level. So with that, I'll be using this zone 1.3670, 1.3690 as my short-term pivotal resistance zone to flip to a intraday bearish bias for this mean reversion decline scenario to play out within a medium-term uptrend phase that is still intact for the sterling dollar. First support level to watch where it survived yesterday with the 20-day moving average at 135.70. A breakdown below 135.70 may expose the next near-term support level at 134.70. All right, over here. It's a bit of error. 134.70. All right, at 134.70, which is the 50-day moving average. So once it hit that 134.70, like I explained earlier, I'll be looking out for bullish elements to flip my owners back to the bulls instead of continue to play that bearish down move. Because given the fact that the overall longer term picture still skewed towards the bulls rather than skewed towards the bears, as I highlighted on the daily time frame chart. However, if price action managed to survive and do a bullish U-turn, breaking above 136.90, then I got to respect the price action and to state that the owners now has started to turn back to the bulls for it to recover and revisit 138 figure slash 138.30 in first step. So that's for the sterling dollar, flipping to a bearish bias, but only for a mean reversion decline view rather than the start of a medium term downtrend view, using 136.70 slash 136.90 as my short term pivotal resistance zone for today. Next up will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar, like I highlight yesterday, it managed to form a minor top at the 166 figure level, given the fact that it has started to trace out a five-wave inert wave pattern after that bullish breakout from 65.30, which is a we call it a 7 week plus of range consolidation previously in place since the low of 24th of April. So given the fact that the hourly RSI also continues to remains bearish, can't break above this lower high over here, and now inching back down towards the 50 level mark. So without doubt still maintain our bearish bias for the mean reversion decline to play out, to revisit the pullback support of that former medium-term range resistance level at 65.30, then below it will be 65.10, which is the 20-day moving average. So still maintaining our bearish bias for that mean reversion decline to play out at 66 figure level, short-term pivotal resistance level, support level to watch 65.30 slash 65.10, and once price hit between 65.30 and 65.10, I'll be looking out for bullish element to reinsert back my bullish bias view on the Aussie dollar, given that it managed to just broken out above this 7 week plus of former range consolidation last week. However, if price action, instead of coming back to retest 65.30 and did a bullish U-turn, I got to respect it, and a breakout above 66 figure level, the bullish impulsive wave will continue and invalidate our mean reversion decline setback scenario for today, to see the next resistance coming in at 66.30 followed by 66.45. That's for the Aussie dollar. Lastly will be the dollar yen. So the dollar yen yesterday retest our pivotal resistance zone, a tightened one, before trading back down. So this is indeed a resistance level or inflection level that prevents the bulls from surpassing higher, and that was also the former medium-term ascending range support from 22 April 2025 low, broken down on this Tuesday, now turns into a key short-term pullback resistance level. So no change, still using this 143.90, 144.15 short-term pivotal resistance zone to maintain our bearish bias on the dollar yen. First support level to watch will be at 143 figure psychological level. Only a breaking down below 143 psychological level may expose the next near-term support level at 142.40, which is the minor swing low of 3rd of June. However, if price action did a bullish U-turn and surpass above 144.15 with an hourly close above it, then we may start to see another round of choppy corrective rebound sequence to go back up towards the top of this sideways range configuration that the dollar yen is still trading since the low of April, this kind of complex sideways range configuration. So the next resistance level to watch after 144.50 is taken out will be the 20-day moving average at 144.60. Above it may see the minor swing high area of 26th of June and 30th of June, and as well as this former minor congestion area here at 145. So it's a zone, 145 figure slash 145.20 next. All right, so that's for the dollar yen. Next up will be the major stock indices, starting with the Hong Kong 33. So the whole 33, like I explained, it was very bearish today over here because of number one, two things. It got hit, the very steep slowdown in growth by the Caixin Services PMI for China for the month of June, and as well as the potential China tit for tat measures hitting US, where US has this 40% transshipment levy on Vietnam, indirectly targeting China, asking China not to use Vietnam as a conduit to escape US higher tariffs. So that causes the Hong Kong 33, which is the prox, which representing the Hang Seng Index, to come break above our first resistance that we highlighted yesterday at this 24 23,270 level. All right, so during the Asia session, right at the start of it, it attempt to break over here at the 9 a.m. mark Singapore time, but can't break and starts to trade lower. And right now, it managed to find support at our pivotal short-term support that we highlighted yesterday at 23,880. But however, the hourly RSI doesn't look great as it's broken down below a parallel ascending trend line support over here. Okay, it doesn't look that great. It's broken down below it. So with this kind of not so rosy momentum, I don't want to be so outright bullish for today, despite it still hold on to the short-term pivotal support that I highlighted yesterday at 23,880. So for today, I was flip to a neutrality stance first and observe the price action, how it evolves. So neutral between 23,880 and 24,270. So for sure, the bulls got to break out fast above 24,270 that got rejected on Tuesday and rejected on today's early Asia session before seeking out the next resistance at 24,490, followed by 24,850, which is the top of this minor ascending channel that is in place since 2nd of June 2025 low, and also the medium term swing high area of 18th of March and 19th of March this year. But however, if price action starts to break down below 23,880, then what we could see is the extension of this minor corrective decline to revisit the lower part of this minor ascending channel area at 23,690 / 23,560, followed by 23,300 23,330, which is the lower limit of this minor ascending channel and also confluencing with the rising 50-day moving average. So that's for the Hong Kong 33, flipping to a neutrality stance for today between 24,270 and 23,880. Next up will be the Nikkei 225 or the Japan 225 representing the Nikkei 225. So what I could see is that the hourly RSI continues to be bullish. It's going to print out a series of higher low after yesterday's bullish breakout and its prior session bullish divergence that's been formed on the oversold area. So with this positive observation that's being seen on the hourly RSI, continue to print higher high as it goes back above the 50 level mark, we will still maintain our bullish bias stance. From a technical perspective, that corrective pullback kind of exhibited by Trump's threat of that higher tariffs of 30% to 35% more likely lead to the ending point of a corrective minor wave fall, where this we call it from technical perspective inflection level, where the bulls may start to take hold again. And given the fact that it continues to bounce up above 39,390, for sure this will be indeed a key support level to watch to maintain our bullish bias for today as well. First resistance level to watch remains at 40,040, followed by 40,355 for today. So still using 39,390 to maintain my bullish bias for this recovery to take shape, potentially indicating that corrective wave 4 may have already ended yesterday and supported by the bullish observation that's being seen on the hourly RSI. However, if price action start to do a U-turn and break down below 3,390, then I'm going to respect the bearish price movement to indicate that there could be another extension of this minor corrective decline to expose 39,145, followed by 38,850, which correspond to the pullback support of that former range configuration that was previously in place since 13th of May. So this is the former minor ascending range configuration that was taken out on last Wednesday. And this will be the key pullback support, which also correspond to the 20-day moving average. So once price action hit the 38,850 level or very close to it, I'll be looking out for bullish elements again to flip back to bullish honors. All right, so for now, still using this Titan short-term pivotal support at 39,390, given the fact that the hourly RSI continues to print out bullish momentum observation. All right, so that's for the Japan 225. Germany 30 next, which representing the German DAX, also continues to print inch up higher, and also the hourly RSI also continues to shape a higher high, and right now it's now floating back above the 50 level mark, hasn't hit the overbought level yet, indicating that the bullish bias has starts to return after the close retest at the 50-day moving average. So I will adjust slightly the pivotal support level for today to make it down exactly at this level here, which is the 50-day moving average. All right, so let me adjust it. Okay, so that will be 23,570. Okay, adjust it. Given that now is also reintegrate back above the 20-day moving average after a whipsaw around it on Tuesday. Okay, and also the hourly RSI continues to print out higher low above the 50 level. Right, so resistance support level slightly adjusted one upwards at 23,570 to be in line with the former minor swing low of 26th of June, confluencing with the rising 50-day moving average. Still maintain our bullish bias for the Germany 30. First resistance level to surpass were previously the breakdown level on Tuesday, which is 22,890. Above it sees 24,111 next coming in, followed by 24,260, which is a one-time Fibo extension, and the minor congestion area of 6th of June and 10th of June. However, if price action starts to U-turn and has a bearish breakdown and hourly close below 23,570, then we may see another round of choppy corrective decline movement again, invalidating today's bullish buyer stance to expose the next support level over here at 23,440. Okay, let me put it in writing. 23,440 and below 23,440 exposes 23,150 next, which is the minor swing low of 23rd of June and 24th of June. So IE still maintaining our bullish bias stance on the Germany 30 as it continues to be holding above the rising 50-day moving average. Now using it as our in syncing it with our adjusted pivotal support slightly upwards at 23,570 for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to trade higher. Yesterday, it almost hit our first resistance before shaping that pullback. And right now, the hourly RSI also continues to bounce up from the support level at this parallel ascending trend line support level over here. Yep. Okay. And also going back up above the 50 level mark as well. Okay, so indicating that the bullish momentum still remains intact. All right, now back at the 50 level mark. Okay, so with that, no change. We still maintain our bullish bias over here. So first support level to watch will be yesterday's US session low. Okay, which is at 44,400 level. So 44,400 level, first support level. So I will only tighten my short-term pivotal support to 44,400, which is so bouncing off from the lower limit of this minor ascending channel that I drawn from the low of 24th of June, unless we have an hourly close above 44,820, 44,820. So for now, still maintaining a slightly upward drift. Previously was 43,965, so I put it higher to 44,170, taking account that this is a minor range breakout, now turns to a key pullback support that occurs previously from Monday and this Monday. Yeah, that occurs on this Monday, right? So with that, slightly adjusted pivotal support level at 44,170 for the US Wall Street 30, representing the Dow Jones Industrial Average above 44,820. Seek out the all-time high area that was previously printed in December last year at 45,100. Above 45,100 sees the next resistance coming in, which is a brand new all-time high defined by the Fibo extension cluster level, and the upper limit of this minor ascending channel at 45,455, pardon me, 45,520. Only a bearish breakdown below 44,170 will invalidate today's bullish bias, a bit of tongue twisting. Only a breakdown below 44,170 will invalidate today's bullish bias to kickstart a minor corrective decline, exposing the next near-term support level at 43,965, followed by 43,600. So still maintaining our bullish bias stance for the US Wall Street 30, using a slightly upward short-term pivotal support at 44,170. Next up will be the S&P 500. So the S&P 500 continues to print fresh all-time high yesterday, almost hitting our first resistance level at 6250 level over here. So no signs of a bearish exhaustion, as well as you could see the hourly RSI managed to break out from a parallel descending trend line, hasn't hit the overbought level yet. No signs of a bearish divergence so far. So with that, I will have a first support level to watch out for today when the US session start. Will be this level here, this congestion level, which is also very in line with yesterday's US session low at 62 so they at 6200, 6200, but still using our Titan short-term pivotal support level at 6175. Unless we have an hourly close above 6250, then I will tighten my short-term pivotal support to 6200. So still maintaining our bullish bias at 6175 short-term pivotal support for now. Above 6250, exposure 6009 6290, followed by 6330 slash 6355, which is defined by a Fibo extension cluster level. Only a bearish breakdown below 6175 hourly close below it that will invalidate today's bullish bias to kickstart a minor corrective decline or a mean reversion decline back towards the 20-day moving average. First two support level to watch: 6136, followed by 6110. So that's for the that's for the US S&P 500. Lastly will be the Nasdaq 100. So the Nasdaq 100 also retest our first resistance level at 22,710 as we are speaking right now. And what we could see over here is that the hourly RSI also managed to stage a bullish breakout as well. And we see a bullish divergence yesterday on the hourly RSI, where price action attempt to actually sell off, but managed to help exactly our short-term pivotal support before bouncing up. So first support level to watch for today during the start of the US session will be this meeting line over here between these two bullish Marabuzu candlestick on an hourly basis, the closing level and the opening level, which is at 2,530. So unless price action have an hourly close above 22,710 on the Nasdaq 100, that I could tighten my pivotal support to 22,530. So for now, still maintaining at 22,360 short-term pivotal support level on the Nasdaq 100, maintain our bullish bias. Next resistance level to watch above 22,710 will be 22,855, followed by 23,190, which correspond with a Fibo extension level. And as well as if we do the current price action of this ongoing bullish impulsive up move since the retest on the range support level on 23rd of June, if we put it up, there will be a minor ascending channel that is forming, and the top of this minor ascending channel also correspond to 23,190 now. So pretty interesting, yeah. So however, if price action starts to do a bearish breakdown with an hourly close below 22,360, today bullish bias will be invalidated to kickstart a mean reversion or a minor corrective decline back towards the 20-day moving average. In first step, watching the next two support level at 22,230, followed by 22,065 next, which correspond to the rising 20-day moving average. Right, so that sum up the intraday technical outlook on all the major stock indices. So very quickly, let us now move to the commodities market, starting with gold XAU/USD. So no change for gold XAU/USD, going to trade within this tight sideways range, still holding above the sideways short-term pivotal support level at 3,318. So with that, still using the 3,318 as my short-term pivotal support, still maintain my bullish bias, but price action got to break fast above 3,360 in order to expose the next near-term resistance level at 3,400 next. However, if price action starts to break down below 3,318, then potentially we may see a revisit down to 3,293 over here. Breaking down below 3,293, we also indicate a breakdown of the medium-term ascending trend line from 31st of December 2024 low. Then that potentially could seek out another round of choppy minor corrective decline. In first step, retesting the minor low of this Monday at 3,250 first. Right, so that's for gold XAU/USD. Lastly will be West Texas Oil. So West Texas Oil yesterday did a squeeze up over here. So after squeezing up, if you look at the hourly RSI, the hourly RSI continues to be rather bullish over here, going to shape upwards. And what we could see is that there's no bearish divergence that is being formed on West Texas Oil over here. So with no bearish divergence being formed on West Texas Oil, there could be a potential retest at this critical support zone of 69.15, 70, 60 area. All right, so let me put it in writing. Okay, 69.15, 70, 60 area. So what I'm going to do over here is that I'll be using this zone here as my pivotal support level. Okay, this previous minor range resistance that was in place since 30th of June and 2nd of July yesterday, broke out, retest, and did that bounce over here. So this is 66.65. Okay, 66.65. So that it will be my short-term pivotal support level for today. So flip to a bullish bias for today for this potential minor bounce to take shape to retest the critical resistance zone on West Texas oil. Why is it critical? Because it's the 20-day moving average at 69.15. Upper limit 70.60 is being defined by that former major descending resistance that was previously in place from 28th of September 2023 high, broken out during the onset of the Israel-Iran conflict, then thereafter plummet downward after a ceasefire deal is being brokered by US in the last 2 weeks or so. Then prices are just trying to trade in a sideways range. So now there could be a potential residual push up to revisit this 69.15/70.60 level. So later once hitting this level, I'll be watching out for a bearish element to potentially flip back to a bearish stance again. So for now, we have still some more room to run. And also the hourly RSI is supporting this bullish residual push up as well. So using 66.65 to actually have this bullish residual corrective push up view. However, if price action starts to break down below 66.75 with hourly close below it, then we could see the honest flipping back to the best again to revisit 64.05 in first step, which is the 50-day moving average. A breakdown below it exposes further weakness towards 62.50. All right, so that's for West Texas oil, and also sum up the intraday technical outlook on all the major asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today will be Thursday. So like I mentioned, Thursday we have two key US data, but before the US data release, let's have a look at the European session. What are the data to take note of? So during the European session, those who are looking at the dollar Swiss franc, we have the Switzerland inflation rate that will be out at 2:30 p.m. Singapore time. Then thereafter, this is the PMI data for Eurozone. That is the final one, so that shouldn't be any big surprises because the preliminary figure has been released earlier, and that could actually start to see the all important 8:30 p.m. non-farm payroll data that could be released today, followed by the unemployment rate. So these two data could influence the major cross asset classes because these are also a key metrics in determining the US Federal Reserve monetary policy decision going forward. And after that, during the same timing, you have the release of the ISM, not Dynamic, 1.5 hour later, pardon me, at 10 p.m. Singapore time, you have the release of the ISM services PMI data. Why is it important? Because services activity constitute 3/4 of US economic growth for the past 10 over years. And given that the ISM services PMI data is a tier 1 leading economic data for US. So that's 10 p.m. Singapore time. Then thereafter will be a rather quiet US session. And when Asia session kickstart early tomorrow morning on 4th of July, before the start of our daily dose at 11 a.m., we have the important household spending data from Japan that is out at 7:30 a.m. Okay, something to take note of that could influence the Nikkei 225 and the dollar yen and the yen crosses. So with that, let's sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you a great day ahead, and we shall speak again tomorrow. Thank you.